Hello everyone, this is Shubhankar and welcome to Everything Has a Story, where I share stories with you which the numbers are trying to tell us. This here is going to be a bit different video. Here we have all the listed companies you can find on Screener.in as on 25th January 2024. All these companies are arranged in terms of its market cap. As you can see, here happens to be 4,486 companies in total. Although, herein you'll find that there are REITs and InvITs as well. So technically not all of these are companies. I'll actually be sharing a series of posts on LinkedIn on the macro analysis of the Indian stock market, and this here is going to be a complimentary come explanatory video to the same. So here you can see I've downloaded all this data for all these companies. I'll explain most of it in a minute. And here I've hidden some data as well regarding the pricing of each of the share as on 25th January 2024, right? To start off with, what we'll do is I'll be selecting this, creating a new sheet. Right, we don't need this. Then what I'll do, although it's still arranged by the market cap itself, and herein it's going to be rank 1 and 10. Right, okay. So what we'll do is we'll select all of this and create a pivot table. Okay. To start off with, we'll take rank and then we'll take market cap 4 times, 3 and 4, right? So what I'll do next is I'm going to summarize this, show these values as total. So this means that rank 1, which is Reliance, right? It represents roughly 5% of the Indian share market in terms of market cap. Here we are going to summarize it by count, means 1111 company, right? And here what we are going to do is again summarize it by count and then show this as percentage, which means in terms of numbers, out of 4,486 companies, one happens to be 0.02%. So let me format this a bit. Okay, I had already done this before. So this is the same thing. I've just formatted it a bit better. Here's a chart also here. So what we'll be doing next is we'll be grouping this in tens, right? So this means that the top 10, first to 10th rank companies, right, represents 23.54% of the Indian share market in terms of market cap. Next, we'll group these in 50s, right? So 1 to 50. The top 50 companies like Nifty 50, which happens to be 1% of the Indian share market, actually represents 50.22% in terms of market cap, right? The next Nifty 50, right? So this represents 13.38%. Please note that anything being shown here or said here or the post I'll be sharing on LinkedIn should not be taken as any kind of investment or selling recommendation or advice, and this should not be taken as me being a representative of the institute I belong to, the degree I hold, or the company I'm working for, right? I'm just a finance enthusiast who is learning things as I'm like spending time in the stock market, and I'm just sharing those things with you. I'm not claiming to be any kind of expert here, right? So next what we'll do is we'll be grouping these in hundreds. So the top 100 companies represents 63.6% of the Indian share market, right? Next we'll group these in 500. So you can see, right, the top 500 companies actually represents 91% of the Indian share market. Okay, so here is a blog from Grow.in, right? Here what you'll see is, as per SEBI, right, the top 100 companies can be considered as large cap. Then the next 101 to 250 companies can be considered as mid cap, and anything beyond 250 first to the end, like can be considered as small cap. So what we're going to do is, here what you'll see is the top 50, the top 100 companies, right? Those represent 63.6% of the Indian share market, and they're only 2.23% of the market, right? The next 100 to 101 to 250 companies actually represents 17.86. Here you have to notice the sum, right? 17.86%. Whereas in terms of percentage, they happen to be 3.34%, right? And then the remaining, which can be actually considered as small cap, only represents 18.55%. Although these happen to be here 94.43% in terms of numbers, right? 93.43%, and pure numbers happens to be 4,236. Here with the same blog, what you'll find is that anything around or above to 20,000 crore can be considered as large cap. Anything between 5,000 and 20,000 crore market cap can be considered as mid cap, and anything below 5,000 can be considered as small cap. So here we have the original data. What we'll be doing is we'll be filtering like 20 greater than anything greater than 20,000 crores, right? Here what you'll notice is that all of these happen to be 84% of the Indian share market, although there are only 292 companies as like large cap companies, right? Then what we'll do is anything greater than 5,000 and is less than 20,000. These happen to be 10.6% of the Indian share market, whereas in terms of number, it happens to be 382 companies, right? And last but not least is 5,000, right? Small cap companies. These only represents 5.4% of the Indian share market, although there happens to be 3,812 companies. Okay, coming back to the pivot table, what we'll do next is we'll be adding sectors to the rows, and then we'll remove ranks. Okay, and now what we are going to do is we are going to sort this by largest to smallest. So this here means that any company that has been categorized by Screener.in as banks, their cumulative market cap happens to represent 12% of the Indian share market, right? Then IT software happens to represent roughly 11%. Next, what we are going to do is add industries to it, right? So what you'll notice here now is that under banks, there happens to be private banks and public banks, right? These two, when added, here you can see 11.95, the same as the sector, right? This is how this is done. And again, what I'll do is sort this largest to smallest, right? So you can see under IT software, right? Software large companies happens to have the highest market cap within the sector, right? And there only happens to be 8 companies. You can understand how concentrated the market cap here is. Whereas the next medium to small, they only represents roughly 2% and there happens to be 233 companies. Okay, next what we'll do now is add companies to this list, right? And now what we're going to do is we are again going to sort this largest to smallest. So now here we can see that within private banks, HDFC happens to have the highest market cap. We can do one more thing here. We can add market cap once more. So here you can see that I've added market cap once more and renamed this as ranking, right? So what I'll do next is show these values as ranks, largest to smallest, and by company name. So what you can see here is that HDFC Bank under the private sector happens to be rank 1. So here you can see now that I've collapsed private bank, but you can see here under public sector banks, SBI happens to have the highest market cap, rank 1, right? Under IT software, computers, software large, TCS happens to be rank 1, then Infosys rank 2, right? And again, here you can see, right, the industry computers, software large within the IT software sector happens to have 8.56% of the entire Indian shares market cap, and only 8 companies are having these, right? So here you can see these are the 8 companies here. So on Screener, what you can do is go into IT sector software, right? And here you can select TCS. And under TCS, what you'll find is computer software large. Here are the same 8 companies. Okay, coming back to our database, what you'll find is here in sector analysis, what I've done is the same thing here, right? What we saw in the pivot table, I've arranged and added all the market cap and everything else under the banking sector and arranged these in terms of their market cap, right? Same goes for industry analysis and then sector top players, right? Which means that under bank private sector, HDFC, because it has the highest market cap, these are arranged in these terms, right? And here you can see that the market cap isn't the only thing being calculated here. There's so much more data available here. I'll explain all of this in a minute. Okay, before we proceed, I have to explain a few more things. Like here, the market cap, here is the calculation. I've added all the numbers under market cap and shown this as a percentage here, right? The share count has been calculated here. Let me explain how it is being calculated. So here, this. So what I've done, I've divided the market cap with the current market price, of course, as on 25th January, right? And then there is debt, cash, enterprise value. I've also calculated enterprise value. So what you'll see here is market cap plus debt minus cash. Here, the enterprise value is calculated. This is something important. The book value per share. I was able to pull this data from Screener. And what I've done here is I've multiplied that with the number of shares. And hence, I got the book value. What happens to be the book value? Book value happens to be the net worth of the company, or like call it the shareholders fund, right? So I've used the same in calculating a capital employed. Is it the exact number here? No. But I have used that because that's the only data I was able to pull. Here's one more thing to notice, that few of the companies don't have the book value per share mentioned on Screener. Here you will notice that out of 4,486 companies, there are 137 companies found where the book value per share is missing, right? So let me show you just one more thing here, that there happens to be 137 companies, but they only represent 0.9% of the Indian stock market. This is the reason I am okay with not having this data, because this won't affect our macro analysis too much. Okay, now let me explain the reports I'll actually be sharing on LinkedIn. Here what I've done is, here everything is calculated in terms of sector, right? This is how the market cap of all the companies categorized in the bank is added up here. So is the debt. So here what you'll notice is for the entire listed space, 70% of the debt is with banks, right? And 58% is with like cash. In terms of cash, it's with banks. What again you'll notice is that for banks and finance companies, both of these as a group represents 83.7% of the debt of the listed space. Few things to remember, that bank, finance and insurance companies happen to be a bit different. Okay, to explain the same, let me take the example of Domino's Pizza's business model. This here is just to give you a brief idea, not a very in-depth analysis of the business model of anything I'll be discussing here. So, in terms of Domino's, what you'll notice is that their like raw materials for them happens to be meat, veggies, cheese, and they then process it and make pizza, garlic bread, tacos, right? And then they sell those. So, what happens in Domino's business model? They require funds, they require cash, right? They're in need of cash, and with that fund, they are able to buy themselves raw materials and then process it, and they are able to sell the products, in return to which they get cash again, right? So this cash here, right, is funded via two methods, equity and debt, right? So Domino's might be taking debt from banks in order to get this fund. But when it comes to banks, right, for banks, fixed deposit, bonds, current accounts, saving accounts happens to be the sources, the raw materials, and this then in turns provides them with sufficient funds, and then they repurpose those funds in terms of like loans and business loans and whatnot, and they give these loans to other businesses. So what is different in the case of banking business, right? For them, cash itself is the raw material, right? And the end product also happens to be cash. So on deposits, on bonds, they must be paying you some, or like whoever holds it, some interest, right? For the same thing, like the loans, they are charging a rate of interest. And whatever happens to be the difference between those interest rates happens to be their spread and their profit, right? In case of insurance business, what happens? There are various policyholders, everyone is paying some premium, and all of this, when added up, happens to be the fund for insurance business, right? And after some time, whenever like something happens, you claim that and get that money back, right? And let's say in case you were investing via the insurance business, so there are also some financial like products being sold by them, and in that case, you are expecting a return, right? So again, in case of insurance business, the cash happens to be the raw material as well as the end product. So what happens? These funds, right? They have collected from all the policy holders. There's whole this actuarial calculation that out of 100 people, only this many people will actually be claiming, right? So let's insurance business happens to be of two categories: life insurance and non-life insurance. So like in life insurance and in, let's say, health insurance, you might have been paying the premium for a few years now, but you haven't claimed it yet, or your family hasn't claimed it yet. So the time duration here, there is a time gap between you giving them the premium and actually claiming something or expecting a return. So there is a time gap. So you must understand a bit about time value of money. So what happens is that they use those funds because there is a time gap. They use those funds and they invest those, right? And with those investments, they get profits, they get interest, right? Dividends and whatnot. So all of this again happens to add up to their funds, right? And then they return it to you in terms of claim or maybe in terms of return. So what is happening? What is different about the insurance business? It is a two-part business, right? First major thing for their top line growth happens to be how much premium they are getting, right? New premium, what is the renewals as well, right? And the second thing happens to be for them is the return they are able to generate from the investments, the funds they have, and they're parking it or investing it somewhere, and what return they are able to generate from it. AMC business also happens to fall under finance category as per screener, and under finance category also notice that there are NBFCs, right? So in case of AMCs, what happens that there are many mutual fund holders, they are giving SIP or doing some lump sum investment, right? And this again generates a fund, right? And AMC businesses then hire professionals, and those professionals actually make those investments and generate profit. So they are actually charging you a commission for the same, right? And the larger the AUM happens to be, the larger the commission is. So for various businesses, the financial matrices to be actually looked at are different. Let's say in case of Domino's business, for them it happens to be same store sales growth, right, which is a relevant metric. In case of banks, it is numerous things. You have to look at the non-performing assets, gross non-performing assets, net NPAs, right? You have to look at if there is a liquidity mismatch, asset liability mismatch, or is there a liquidity problem there. You have to look at PPOP, pre-provisioning operating profit, right? And in case of insurance business, it is again different. So the valuation done here is different. In other businesses, what we look at is EV, right? Enterprise value. But in case of insurance businesses, we're actually looking at embedded value. And in case of AMC business, what we have to look at happens to be AUM. So before we can proceed with our macro analysis, what we'll be looking at is a few businesses like Reliance. So what you'll notice is that interest, right? Interest here. So again, Reliance doesn't happen to be a banking, insurance, or a AMC or finance business, right? So for them, they are taking debt and they are paying interest on the same, right? So this doesn't happen to fall under their main business category. Okay, now here we are looking at Reliance's annual financial statements, right? So what you'll notice is that this happens to be the businesses, right? There's retail, there's digital services, media, entertainment, O2C, right? O2C happens to be the major contributor to their revenue. Even in the financial statements, what you'll notice is revenue from operations, right? O2C, oil and gas, retail, digital, and here are the amounts. Whereas in their other income, there is interest, right? There is interest, but what is it? Like bank deposit. So this is a very big company. They must be having some cash in their banks, right? And they must be earning some interest on the same. But does it fall in line with their primary core business? No. So we did talk about Domino's Pizzas, right? So Jubilant FoodWorks. What you'll see is their annual report here, and this happens to be their quarterly report. What you'll notice is that here, right? These are the various brands they are running. So for Jubilant FoodWorks, what you'll notice is there is sale of products, right? Manufactured goods and traded goods. They are also selling some kind of soft drinks as well. And this happens to be their revenue, right? But when we look at their other income, again, you'll see interest income, right? On bank deposits, the same thing as Reliance. So in other income, mostly for normal companies, whatever income is included there doesn't happens to be from their core business. So now let's look at, let's say, HDFC Bank. What you'll see is here that interest for them is a core thing, right? Here the interest is on top. See, let's look at Jubilant FoodWorks as well. The interest is here. Interest, yeah, right? So it's 000, and then here is, so they must have taken a loan during 2020, right? Borrowings, here you'll see lease, right? Lease. They have taken a bit of loan, and on that they are paying interest. So now we'll be looking at HDFC's annual report 2023. So this is HDFC's financial statement. One thing to remember that for non-banking finance and insurance companies, their financial statements are prepared as per Companies Act. Whereas for banks, it is prepared as per banking regulations. And in case of insurance businesses, it is prepared in terms as per the guidelines of IRDAIs, right? Insurance Regulatory Development Authority of India. So now looking at HDFC's consolidated profit and loss statement, what we'll see is income, right? For income, it happens to be interest earned, right? Whatever loan they are giving, they're earning interest on it, right? And then there is interest expended. And here is the other income. We'll look at note 14, schedule 14 a bit in a moment. So here is the provisions, right? So there's income, there's expense, and then there happens to be the profit, right? But what you'll notice is that there is provisions. So they have to create provisions in case of any defaults. So different banks do different rate of provisioning. So this is the reason why we have to look at PPOP, pre-provisioning operating profit for banks. Now let's look at other income. So it was schedule 14, right? 14 here. So other income, right? For them, it is commission, exchange, brokerage. Here they are selling investments, and this year is a sale of building, although the amount is very low. So the main thing you'll see is commission, exchange, and brokerage. So you might have noticed that there is HDFC Bank, there's HDFC EMC, there's HDFC Insurance. Same goes for SBI and ICICI, right? So they are cross-selling, while the banks itself are cross-selling insurance products. Then they are also selling mutual funds, and they are receiving commission for those, right? So for them, the other income happens to fall somewhere or the other in their main business itself, right? Also, there are many processing fees they are charging, right? Which might not be actually be included in their primary income, because here we did notice that for the income portion, there was for the income portion here, we did see it was interest earned, right? And the second category was other income. So they have no option but to show their processing fees and other fees, like even they are maintaining your accounts, bank accounts, and SMS fees and whatnot. So this must be coming under their other income. Now looking at HDFC AMC, what you'll see is AUM, right? AUM happens to be a very relevant metric in terms of their financial comparison when you are doing a P2P analysis. So now looking at HDFC AMC's other income, again you'll see income from investments, right? So again, in their other income, these again happen to fall under their core business. Here looking at their consolidated profit and loss statement, here again you'll see revenue from operations, which happens to be asset management services, the commission they are charging, right, for maintaining those funds, for investing those funds and generating returns. And then there is other income, right, the return they must be getting. Now let's look at HDFC Life, the insurance business. So remember that HDFC Life is an insurance business. So its financial statements are prepared as per IRDAI's regulations, right? So here is balance sheet, then there is profit and loss statement, but you'll see there's a revenue account as well, right? So what you'll notice here is that there are premiums, there is reinsurance, right? Income from investments, right? Remember, insurance business has two parts, one premium and the income they are able to generate from the investments. So let's look at HDFC Life, right? So when we look at its profit and loss statement, what you'll see is the income here happens to be 70,207 crores. So coming back to the financial statement of HDFC Life, what I'll be doing is, this is the total income here, right? And then subtract the other income subtotal. And then what I'll be doing is going to their profit and loss statement and adding income from investments, right? So it's going to be 6759350 plus 899898 minus 420 4. This is in thousands. So to make it into crores, what we'll do is this. So we did just calculate the revenue here, right? 70,207. One more thing to notice, I do have a extension here, a plugin. So I'll run that. And what we'll notice is this is the balance sheet. Now we have the common size analysis available here. So what we'll notice is for insurance business, right? Here is the other liabilities. See how high the percentage is. And again, investments, right? So even the balance sheet is different for them. The accounting metric is also different, right? So again, for HDFC Life, remember I told you about embedded value, right? So this is the embedded value calculations here, right? Indian embedded value, right? This is relevant for insurance businesses. Okay, coming back to our macro analysis, although I did show you various things, but most of the analysis I've done here is based on whatever data I was able to download from screener.in, right? So not all of it is relevant, especially for finance, banking, and insurance businesses, right? So let's look at few of the things. Remember the book value thing, right? Book value per share. Some data was missing, right? So here in refineries, what you can notice is that all 8 companies are actually representing 17.5% of the revenue of the listed space, right? EBITDA calculations here, right? Again, because interest happens to be a primary expense for banks, you should not be looking at the sector total EBITDA divided by the total EBITDA things, right? Going forward, right? Again, one thing to remember is that the net profit as per screener actually includes other income. So what I've done is I've named this PAT, although the nomenclature is quite used interchangeably. But what I've done in PAT is I've subtracted the net profit, I've subtracted the other income from net profit, right? In order to get the core profit being generated by the businesses, right? So in case of banks, this is not applicable, but I've still included it. You should actually remember this, that this is not relevant in case of banks and finance companies, right? Sector capital employed. Here are the financial ratios. So like EBITDA margin is calculated by like dividing EBITDA by revenue. So what I've done here is the sector's total EBITDA divided by the total revenue of the sector, right? So here you're getting the margin. The margin happens to be quite high here. Again, you have to remember that for banking and finance companies, interest is a very integral part. And here in EBITDA, we don't take in consideration the interest thing. Yeah, I've also shown other income as a part of revenue, right? This happens to be quite high, right? So as per me, it's not a very good thing to have very high portion of your like profit being generated because of your other income. That's the reason why I've shown this calculation. Here you can see that banks and finance companies happen to be very highly leveraged, right? The debt equity happens to be quite high for them. Now going to the multiples, right? Again, these multiples are not applicable for banking, finance, and insurance. This is EV enterprise value, not embedded value. Remember that. Now going to industry analysis, right? Here what you'll notice is that it's the same thing again, but here everything is being calculated in terms of industry and not sector, right? Every calculation here is the same. Now going to companies, this portion I'll not be sharing on LinkedIn, right? Again, remember the pivot table. Again, these things are arranged in the same manner. Banks on top because banks happen to have the highest market cap, right? As a group, and private sector was in top, right? So if we go a bit right, what you'll see is, okay, so the private banks happen to be 8.3% of the entire listed space market cap, but this 8.3% for this 35.7% HDFC Bank is responsible for this, right? This is what this here is being calculated, right? If we go down now a bit, what you'll see is now banks, then there was IT software large, right? This is how this is arranged. So now coming to the industry top list based on their market cap, what I've done here is I have copy pasted all the sectors and industries here, and I've used here VLOOKUP. Because VLOOKUP picks the first data which comes in the database, and I've arranged those in terms of their market cap. So this here is giving you in banks, in banks, there happens to be private sector, and HDFC Bank happens to have the highest market cap, right? So again, the calculations here are similar, but these are here in terms of individual stocks, right? Individual shares. Here, one thing is different is that like cash here is must be for trailing 12 months here, right? The cash of HDFC represents the entire listed space is 6.4%. In terms of the banking sector, it represents 11%, but in terms of industry, which happens to be private banks, represents 28.2%, right? These calculations are calculated here. Okay, few things are different here. Let me just book value is okay. Revenue, the margins also calculated here, right? Here are the margins. Okay, yeah, multiples, right? The PE ratio here was pulled from screener. I've not calculated this here. Now let's look at, okay, so the difference between PE and core PE, right? It is also applicable for the industry analysis as well as sector analysis. The PE here is full from screener, right? But in case of industry and sector, it has been calculated. So the calculation there was net profit divided by the market cap of the industry or the sector. Whereas in case of core PE, the core business profit has been calculated here. So remember in PAT, what I did was I did remove other income from net profit. So this is what is calculated here, right? PAT divided by your market cap rather than net profit divided by your market cap, right? So do remember that. And this I did not include in other analysis, but this is here in individual stocks here. So I have, this is the list here total, the total industries and the top players in terms of market cap. Remember that, right? This is what I'll be sharing on LinkedIn. One last thing to remember is that let's just select this, create a new sheet, and okay, what I'll show you is I'll highlight duplicates and then arrange it, right? So what you'll notice is here, like industry, ceramic, tiles, and sanitary ware happens to fall under two sectors, right? So there might be companies which fall under consumer durables and ceramics, whereas there is another sector as well, ceramic products, and within that sector they're also falling under the industry. So remember that calculations done in my analysis is when the company or the companies, group of companies fall under both the sector and industry. But when you look at screener, what you'll find is under the industry, you'll also find companies which fall under both these categories, right? Like here you can see computer education, there's education, there's IT software as well as computer education. I don't know why it is, but because I'm using screener.in and that's the limitation here, right? Now coming to a few interesting things I was able to find, right? So this is how you can actually use these reports. So in the sector telecom service, right, what you'll notice is the book value happens to be negative. So what you can do is when you go through my reports, you can go on screener, go on sector and select like telecom service companies. Here you can edit the columns, right? So I've done this on like whatever I feel comfortable with. So you can see all the telecom service companies. So what you'll notice is the reserves, right? The equity is positive, but the reserves here, right? Very large negative numbers. This is the reason why as a consolidated number for the telecom service sector, you'll find the book value is negative, which means that like Vodafone and the other companies must have been incurring losses for a long period of time, and that has accumulated in their reserves. Similarly, you will find this here, right? Here for air transport service companies. So what you can do here again is go to air transport service companies, and here looking at, again here you can see, right, the reserves are negative. This is the reason why the book value is coming negative as a group, right? So there is one very interesting thing I found during this analysis, like the financial ratios, right? 102% EBITDA margin for an industry, right? So this happens to be finance housing companies. So we'll go to screener. This is something you won't find easily because like under sectors, you have to go under sector and find a company which happens to fall under the finance housing companies. I just selected LIC Housing Finance. So there I was able to find finance housing companies, right? So we did see the operating profit margin or like the EBITDA margin was quite high. So here we have the sales number and the operating profit numbers, right? So when you look at Reliance Home, what you'll see is the sales happens to be 391 crores, but their operating profit happens to be 9,324 crores. So now let's look at Reliance Home. We can go to profit and loss statement. What you'll find is their expenses were negative, right? This is the reason why you can see the operating profit is quite high. You can see here the margin, right? 2,384%. So now we'll be deep diving into it. What we'll do is open Reliance Home Finance annual report, right? So what you'll find in Reliance Home Finance's profit and loss statement, you'll find under expenses, there's impairment of financial instruments, which happens to be negative, right? So we'll be looking at note 30 here. So under note 30, what you'll find is impairment of financial instruments, right? And you will see it happens to be negative. And then again, we are told to refer like note 58. So here is note 58. Here you can see very long, right? So I haven't read this completely, but what I was able to understand, let me just share it with you. So due to a sudden adverse developments in the financial sector due to IL&FS crisis, right? There was an impact on their liquidity position, right? For major non-banking finance, housing finance companies, right? And this adversely impacted, resulting in a liquidity mismatch. Remember, I was talking about banking companies that there must be asset liability, there should not be asset liability mismatch, there should be proper liquidity, right? So because there was a liquidity mismatch, they were not able to service dues to their lenders. So I haven't read this, but what I'm able to understand is that because of this liquidity mismatch, what happens during crises, especially banking crises, as far as I am able to understand, that when these things happen, everyone starts like liquidating their bonds and stuff, and that might have impacted them, and because of which they must have had to sell their financial assets. Impairment of financial assets represents the difference between your book value of the financial assets and the market value, right? So this is the reason why they had to sell their financial assets in order to provide get some liquidity in order to service their dues to their lenders. So these were a few examples I was able to give you. When I'll be sharing this, you can go through these and like deep dive into it and go and look into the sector, the industry, and specific companies. And like these were a very few things I was able to find. I couldn't possibly find everything right now. So again, please remember that this is only for educational purpose, right? So this was the macro analysis of the Indian share market I'll be sharing, which will be in terms of sector, industry, and the industry top players, right? The LinkedIn thing here is that this is what I'll actually sharing for the sector industry top players, right? Here, what you'll notice is I haven't given the numbers here, right? I've only given the ratios here in terms of financials, and here it is again in parts and pieces because this is more presentable, right? In terms of post. So this is what I'll be sharing. So I have also been diving into sector analysis. So in the sector analysis, what I've done is I have downloaded the data for all the companies within a sector, like in this case, pharmaceutical sector, and I've calculated a lot of things here, right? So if you did like this content, did like my analysis, so do like and share this video, and also subscribe to this channel because I'll be bringing this video very soon. Also follow me on LinkedIn where I'll be actually sharing all these analysis. And this was the video, guys. Thank you for watching the video till the end.